Okay, chapter 14, capital budgeting. Um, so, what's different with a capital budget than a regular budget? Well, it's from an expense item, it's a larger sum of money, and it's usually something that has a useful life of over a year, right? So, from the very first session, capital buildings, equipment, major systems, land, et cetera, useful life of greater than 1 year. So regular expenses, if you will, when we talk about fixed and variable and all those things, those it's a resource consumed within a year. And a capital expense has a useful life of greater than a year. So there's various categories. Um, Mandatory replacement, you know, you're replacing worn out or damaged equipment that you need to run your business. If you're a hospital and your CT scanner dies, you're probably not going to do any of this analysis, right? It would be pointless. You need a CT scanner. If not, you're kind of dead in the water. Um, Discretionary placement. You're going to replace something that's serviceable, but you're going to potentially improve a clinical service. So we had 0.3 T MRIs. They worked. They were fine. The 1.5 T is a better image. Medicare, Blue Cross, in its ultimate wisdom, they don't pay anymore for a 1.5 T MRI image than a zero point 0.3. But we replaced our 0.3s with 1.5s to improve clinical quality. So there really wasn't, you couldn't really make a return on investment case on it. But not everything is return on investment, as we're going to learn. So we replaced our 0.3s with 1.5s to improve clinical quality. Expansion into an existing service, a market. So let's say you have an existing service and you want to expand within an existing service line or existing market. Sorry, increase capacity. So we're going to add, I'll give you examples. We added an addition to our Joliet office when we expanded space in Westmont. I mean, you're going to do some ROI, but it um, it's a fairly lower risk type of a thing because you're presumably doing it because you have already established the demand for the product or service. If you're expanding into a new service or a new market, um, um, you're going to want to do a little bit more analysis because there's a lot more uncertainty with respect to that. So, we expanded into Northwest Indiana. Um, it was a new market for us, as opposed to Joliet, where we just put an addition onto our building. We went into the infusion business. These Munster office was, obviously much more than just doing an infusion clinic, but you're going to do more analysis because there's more risk involved. Environmental projects. We don't need. I mean, it's on the list. We don't need to necessarily go deep into that, but any kind of government regulatory thing and compliance, uh, obviously, you're going to do less intensive analysis because you have to do it. It's not an option. Um, so just some different categories and the level of analysis that you might do. Um, ROI, return on investment. Hopefully everyone's familiar with that term. So, the textbook talks about for profit or not for profit. The fundamentals are the same. Um, what does change? Well, obviously, tax consequences. Um, Again, we're not going to go down that rabbit hole. I, I don't even do taxes myself, but recognize that if you are in a for-profit business, you know, the tax component comes into play, um, whether it's through incentives, tax breaks for capital improvement. I mean, even something as ridiculous as you buy an electric car and you can get a $7,500 right tax credit. You can improve things in your own your home, and you can get tax credits for being energy efficient. So there's like-minded or like-minded. There's analogous things in the business world with respect to incentives, and it just beyond the scope of this class. But if you are in a for-profit company and you're analyzing some major capital project, it behooves you to talk to the CPA firm that does your taxes to see if there are, tax benefits and breaks and issues, etc. Obviously, the other big thing, a not-for-profit, right? We have a mission. So the for-profit investor-owned company, their mission is honestly to create wealth for their shareholders. For a not-for-profit, the mission, I mean, obviously you have to make money to survive, but the mission's never going to say to make money. Even though if you don't make money, you can't accomplish the mission. So, textbook has this chapter or net present social value. The most important thing relative to that chapter is few organizations actually attempt to qualify net present social value. I don't understand why they bring in some of these goofy things. The bottom line is, your not-for-profit probably has a lower return on investment threshold than a for-profit company, right? But none of this changes the fundamentals. So, there's an example. I did this project for Michael Reese. Most of you probably don't even know what that is. It was a huge academic medical center in the South Loop area. At one time, it had more NIH grants than any institution in the country. And we had some funds available. And, we did a Planned Parenthood clinic in the area. And you couldn't really justify any of that on a return on investment threshold versus other alternatives, but there was a mission. And we took into account the mission of the institution. So, this return on investment and all this stuff, it's just one aspect, okay, of how you consider to do capital projects. We'll talk a little bit more of that later. And then the third kind of big major difference is funding sources. So, a 501c, a not-for-profit 501c, can accept non-tax donations to help with a capital project. So this is a huge, distinguishing factor versus a for-profit company. It doesn't change any of the principles. It just, potentially changes the investment, net investment. So, you may say investment minus donations equals your net investment. And there's so many, almost any capital campaign in a hospital, they use it as a funding vehicle. A cancer center, a, a joint center, a women's health center. I mean, the fundraising department of a hospital likes nothing better than to have something that it can latch on to, a big capital project to inspire people to donate money and get their names on a plaque, or maybe even get their names on the building. Um, so, high level review of the process. We estimate the cash flows. So there's three components. We're going to just focus on two. Capital outlay, that equals your investment. Cost of the project. I'll also refer to it as the lump sum, right? So the cost of the project, the lump sum payment, the investment. The next is the operating cash flows. These are typically the annual cash flows that are going to come in, right, from operating the business side of the project. Those will be referred to as cash inflows, annuities. That's another way to categorize it or call it. And then the third concept, which again, it gets a little esoteric, is the terminal value or ending cash flow. So typically we generally, most of the cash flow and modeling that I've done it's like 3 to 5 years, because let's face it, anything beyond 5 years, there's so much uncertainty. It's hard to really measure. But your MRI, an MRI machine, I think ours are over 10 years old, these 1.5s. It's a big magnet. It's not like it goes bad. So the life cycle of a building or a huge capital project, or even something as simple as an MRI, is going to be more than that 3 or 5 years. So we typically don't project out past 5 because of the uncertainty. So what we do to account, let's say we did a 5-year plan, to account for years 6 through 10, we come up with a terminal value or ending cash flow. It's a really a bit. I'm not going to test it or delve deep into it for the purposes of this class. Just something that, practically speaking, most of you aren't going to be getting involved in these esoteric discussions about valuing terminal value cash flow. But I just want you to know that it's another aspect that is considered. The second thing or part is estimate of the riskiness of the project. We're going to cover that in chapter 15, very important component. The third is the project discount rate when we use discounted cash flow analysis. So it's very tied into two, but they overlap. In a Venn diagram, there's huge overlap, but they're not completely synonymous concepts, as you'll see. So the text focuses on the corporation's cost of capital to measure the discount rate. It's a measure of the aggregate risk the organization's aggregate risk. If you want to delve into that, you can read Chapter 13 and have your eyes glaze over. Um, Another way to think about it is the riskiness of the firm's average project. The problem I have, um, we're using average is, if my head's in the oven and my legs are in the freezer, right, my body temp may still average 98.6, but I'm kind of in a heap of trouble. So for now, we're going to use the cost of capital as the basis for our discount rate, and then we're going to talk more about that in Chapter 15. And then number 4 is we measure the impact of the financial impact of the project, and i.e. we build a financial model. And this is why I've been trying to instill a discipline with respect to how we build these financial models, checking our work, not embedding assumption values into formulas, not, using, if we're going to decrease a variable, we don't enter that as a positive number and say 1 minus the number. We enter it as a negative number, and we 1 plus the percent change. Just disciplined. You do it in a structured, organized fashion, so you don't make stupid mistakes. So probably the most important thing when you're talking about capital budgeting and project modeling is cash is king. Capital project analysis cares about cash flow out and cash flow in. It's very important to understand this concept. So this is my father. He used to have this, I think he learned this on a troop ship over to fight in World War II or on the way back. It's just such a GI 1940s statement. So if we owed him money, he would always give us this money talks, cash screams. And it's apropos to this discussion. So we care about future incremental cash flows. So let's look at this definition. Incremental cash flow is the additional operating cash flow that an organization receives from taking on a new project. A positive incremental cash flow means that the company's cash flow will increase with the acceptance of the project. A positive cash flow is a good indication that the organization should invest in a project. Okay, so how is this relevant? Okay, we all should know what depreciation is. Depreciation expense. If you don't know, Google it. So when we buy a big piece of equipment, let's say we spend $1 million for an MRI machine. We're going to depreciate it over 5 years. So what that means is, and we're going to do it straight line basis. So we don't take that $1 million and expense it again in our financial statements. The year we bought it is $1 million. We expense it $1 million divided by 5, straight line depreciation. We expense it $200,000 a year, over the next 5 years. So we depreciate that over time. We take that charge to the income statement over 5 years as depreciation expense. So we've already spent the cash, and we're recognizing that expense over 5 years. So when we do this kind of financial modeling, we don't care about non-cash items like depreciation. Okay, we only care about cash in and cash out. So with something like that, when we do financial modeling, we have to account for the fact that we spent the $1 million up front. And then, if we did a financial model to show the profit and loss, and we had that depreciation in the model, which we should, we would have to, and we took it as an expense. We would have to add that back when we do this type of modeling, and you'll see it, to account for the fact that it's a non-cash expense, because we only focus on cash. So timing, cash out initially, we call that the initial outlay, and we usually call that year zero. We measure that as year zero. And basically the major cash flow to invest in the project or to spend it, we call that year zero. And the cash in, the profits from the project, while they accrue on a daily basis, daily sales, daily business, for these longer term projects, we usually typically measure them on an annual basis. Maybe you'll do quarterly. But yeah, for the most part, we use annual. So we need to know the project life. How long are we going to forecast the cash flows? 10 years, 5 years, 20. Again, for the most of the modeling I've done is 5 years. This is a very important concept. There'll be a question on the concepts exam about it, and some of you will miss it. That's kind of a shame. Sunk costs are irrelevant. So what does that mean? So say I decide I'm trying to decide whether to do this project, and I hire. Okay, so I'm retiring in 2 weeks. I've already got people calling me for consulting work. So let's say ABC Hospital hires Dave Gansler to do this consulting project. And I'll give a perfect example of one that I did. Years ago, I did a consulting project for a hospital that had the old style labor rooms and the old style delivery rooms. And they hired me to do an analysis about going to LDRs, labor delivery rooms, all in one. Everyone probably like, oh, there was ever anything different, but 30 years ago, they were separate. You labored in a room, you're ready to deliver. They rushed you down the hall to the delivery room. You gave birth there. Then they have the modern kind of labor delivery all in one area. So I actually found a pregnant woman, a colleague, and we went around and pretended we were husband and wife, and we toured all the LDRs in the area, Prentice and Masonic, etc. And I wrote up a report. And I charged for that report. So let's say it was $10,000. I have no idea what it was. So now the hospital and let's say I said, look, it's going to cost $7 million to do the construction and renovation, and here's your projected cash flows. That $10,000 that they spent for my work is completely irrelevant. Does not factor in whatsoever into any of the modeling or any of the cash flow projections, because it's a sunk cost. It's irrelevant. You can't get the money back. They already spent it. So we only look at cash in and cash out into the future, before that fork in the road. Do we turn right or do we turn left? This is from a movie from the 70s. It was kind of popular. What I've spent up up to this and consultants, to arrive at this decision point is irrelevant. Now, if they want to hire me for future consulting work, for the project, certainly that factors in um, to the cash flow and the modeling. But money I've already spent that I can't get back before I make that decision to go forward or not is irrelevant. And there will be a question on the final. And let's hope this is the year that everyone gets it right. So, project modeling concepts, inflation. Yeah, you got to factor in inflation in your modeling. It's really, we don't really talk about it too much in anything we've done so far with the break even. We did a little bit, I think, in the case study. It's more important just because you've got a long time horizon. So I can tell you in the 70s and early 80s, mid 80s, inflation was way higher than it is today. We're talking about mortgage rates in the teens. So that, everyone's really concerned, and yeah, inflation's bad, but nothing like it was in the 70s and 80s. But the point really is, if we're going out 5, even 10 years, we've got to factor in, okay, employees are going to want raises, rent's going to increase 2% a year, can we count on Medicare increases? So you have to factor that in the longer your time horizon. Strategic value, absolutely. The textbook talks about it, but it's not a financial modeling variable. Okay, so again, the textbook sometimes makes me scratch its head. Strategic value is a non-financial consideration that we use. Obviously, we want to consider it, but let's talk about that when we talk about mission and other things. Effects on existing lines of business. Absolutely, you have to consider this. So the textbook, if the lithotripsy project is going to cannibalize and reduce the business of other services, you have to take that into effect, right? So you've got a your urology practice, you do a lot of kidney stones, you have a surgery center, you're going to do this lithotripsy machine. It's going to zap a lot of your kidney stones, so you're not going to have to do as many surgical interventions. You absolutely have to take that into consent. A great book, kind of a side, if you ever want to read a great book, The Innovator's Dilemma. Cannibalization is really hard, but sometimes it's necessary for survival. So, you look at Sears Roebuck, give some of these references, and I don't know if people know what Sears Roebuck is. 40 years ago, Sears Roebuck was the biggest department store, in the world, right? Walmart kind of hurt them, but they were still the big dog. And if you go back to the 1980s, they were the original Amazon. They used the new technology, the railroads, combined with a paper catalog to deliver product to people in a much cheaper way than it had ever been done before, and much more inefficient. You didn't have to go to the general store or the dry goods store. You got your Sears Roebuck catalog, you put your order in, and the railroad shipped it. So, That's their history. Then you can think of the railroad as the internet of the 1800s. So fast forward, Amazon comes, and Sears, they had a catalog. For God's sake, they had a 500-page catalog. Why the hell didn't they throw that on the internet and change their business model and say, we already have catalog technology, we already have shipping, we already do all this. Let's just throw this on the internet, make it searchable, and crush this little pipsqueak Amazon. But they didn't. They were too busy trying to protect their stores, their bricks and mortar stores, and now they're what? Irrelevant. So I'm not saying. I mean, it's really easy in retrospect, right, for me to bash the management of Sears, but I deal with this a lot I'm working with a surgical robot company and trying to get them to change their model from us buying the machines to doing a per use machine. And it's all this same kind of thing, changing somebody's business model in response to competition. So it's a little off the rails here, but it's a really great book, Innovator's Dilemma. Okay. So, opportunity costs. I don't like the way the book handles opportunity costs. I really, really don't. If you read the chapter. So the example is the market value of the land the hospital owns on which to build the new lithotripsy center is worth 130. So the textbook approach is to charge the project, the lithotripsy project, 130 when doing the project analysis, i.e. add 130K to the estimated cash outlay. So, okay, at one level I get it. You're recognizing the value of that 130 because you're foregoing the opportunity to sell the land. You have to have read the textbook chapter to understand this example. The problem that is you're violating the fundamental tenet of this project cash flow. You're adding a non-cash item to the analysis when we've just discussed that we only care about cash in and cash out. So you just violated a completely central tenet of how we do this. It's not the way I would handle it. I would say we have option A, this lithotripsy project. It's going to cost this much money. We do the modeling. We have option B. We sell the land for $130,000. Those are our two options. Now decide what you want to do. The option B is an alternative use of the land. Okay, let's just compare the two options. Don't be going down a rabbit hole of adding a non-cash item to your analysis. Where does it end? There's always opportunity costs. There's always other things you can do with the space or the funds. So don't violate a fundamental principle of the way we do this analysis. Just say this is our other option. So I don't like this, this opportunity cost as factored in. I like the other opportunities or other options. Frame them up that way. Again, we've got this land. Option A, we build a lithotripsy center on this. This is what it would cost us, blah, 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 net present value. Option B is to sell it and put $130,000 in the bank. So that's my little tirade on that. So before we go any further, we have to talk about Chapter 9 and time value of money. So I didn't assign Chapter 9. It's super important concept. It's really detailed. It's really math heavy. Uh, Most of you probably get lost in it. Um, Not really a slam on you. I got I it took me it was hard for me not to get lost in it. So what I've done is just basically giving you the cliff notes for chapter 9. But you have to understand that there is a time value to money. So that, basically means if I said to you, I'll give you $1 million today or $1 million in 10 years, you would take the $1 million today. And the reason it's worth more money. $1 million today is worth more money to you today than it is to you in 10 years. Because you could put that $1 million in the bank, a safe bank, buy government treasury bills and get 5% interest on your money. And in 10 years, I don't know, you might even double the $1 million. I have to do the math, right? So that's time value of money in a nutshell. So, I mean, if you want to read chapter 9, have at it. So let's just learn discounted cash flow in Dave's shortcut. So you won the lottery. Congratulations, one of you've won the lottery. So you have a chance, and all the lotteries give you the chance. You can take $228 million, and these are actual numbers from a lottery website. You can take that over 30 years, which would be 4.568 million per year. After tax, you get $137 million over 30 years. Or you could take it in a lump sum, the gross 134 million, and after tax 80 million. So the payout is $56 million less. So on the face of it, why would I take it up front? I'm leaving $56 million on the table, right? Why would I do that? Why would I leave that much money on the table? Well, you might decide to take it up front because you can invest that money and maybe you can do better than 56 million. So we can model that and we can account for the time value of that money. And we can compare the 228 to the 134, factoring in the time value of money and seeing if you're really leaving 56 million on the table. So we need to understand these and look at these items in red, and we all know what red means. Excuse me, red means it's going to be something you have to know. So net present value. The difference between the present value of a future cash flow discounted by an interest or discount rate compared to a lump sum value today. Okay, so you need to memorize that. And you figure you'll be tested. Okay, net present value accounts for the time value of money, provides a method for evaluating and comparing capital projects or financial products with cash flows spread over time, as in loans, investments, payouts from insurance contracts, and many other applications. So I want you to read this whole entire page. I'm not going to read it for you, the whole thing. Just going to read the red stuff. So net present value is determined by calculating the cost, the negative cash flow. Generally, that's our lump sum. And benefits are positive cash flows. That's our annuity. for each period of an investment. After the cash flows for each period is calculated, the present value of each one is achieved by discounting its future value at a periodic rate of return. The discount rate, the net present value is the sum of all the discounted future cash flows against your investment. So you can read this at your leisure. This is pretty good definition. So let's talk about these components that the definition mentions. A lump sum payout. So in the case of this, I think I did this after taxes. $80.4 million. In this case, it's a receipt to you, so where everything's kind of the mirror opposite. But basically, it's the same concept. So we consider that lump sum, that 80 million, versus the payout, right? Over 30 years. That's the annuity. So the 80 million is the lump sum, the year zero, and then the 4.58 million each year for 30 years is our annuity. And then the third component is a discount rate, an investment, a percent return, a cost of capital. Again, in this case, since we're the recipient, I've got, it's the kind of the mirror image of capital projects. So that's the interest rate, measures our risk, measures our investment alternatives. Now, if you want to actually do the formula, we actually had to learn these formulas, before Excel and everything else. When I took the CPA exam, we had to not only learn these formulas, we had to calculate them without a calculator. I don't know how they do it now. But you actually had to learn this formula. You won't have to learn the formula. Excel is your friend here. Back when we walked 10 miles to school in the snow and wrote everything with burnt sticks like Abraham Lincoln. Okay, so how do we set this up? So we're doing everything after cash. So let's say here's my annuities, 4.5 million. I did everything after tax. And then the first check I get, 4.5 million, I get it, day one. It's worth 4.5 million because there's no time value. I go to the lottery commission. They say, make your decision. I say, I want the annuity. They give me a check for 4.5. They say, see you next year. So if our investment, we like the S&P, we're pretty savvy investors. We look and we say, historically, the S&P has yielded 13.6% year in and year out. Now this slide's deck is a couple of years old, so it might be a little less now, but go with it. We say, I'm pretty confident that over the next 30 years, I can average 13.6%. So that's my discount rate. That's what I'm going to use. So we take next year's check. I go back to the lottery office in a year. I'm here to pick up my second check. From the perspective of the day you make your decision, which is today, I take that second check, I divide it by 1.136, 1 plus the 0.136, the interest rate. That future $4.568 million a year from now is worth $4 million today, assuming my discount rate is 13.6%. Okay, and we just go back to year 30, we do the math. That $4.5 million in year 30 is only worth $113,176 today, because I've taken into account the time value of money. Said another way, if I had $113,176 and I invested it and I got 13.6% rate of return year in and year out for 30 years, I'd have $4.568 million at the end of 30,000 at the end of 30 years because of that 113 that I invested. So this is how you account for the time value of money. So I add all these up, and I said the present value of future cash flows is 37. The value of those future cash flows, considering that 13.6% is my investment horizon, my measure of risk, etc., that's only actually worth $37 million today. The lottery commission will give me a check for $80 million today. So I would rather take so 37, minus 80 is 43. I did it just an absolute value. So I'm $43 million better off if I take the lump sum, given that I think I can earn 13.36%. So in other words, the logical thing for me to do is to take the 80 million, invest it, hope that I get 13.6%, and I'm going to do way better than just taking this 4.5 million every year, even though I'm going to receive less actual money, because I've taken account the time value of that money. Now, let's assume that I'm really risk adverse. I don't buy the stock market. Okay. Again, this is a couple years old, but just go with me. Let's say I don't buy this. I don't trust banks. It's all a crock of hooey. There's some really safe, treasury bills, long-term treasury bills. I don't play in the market. I just put my money in CDs and stuff that's really safe. So then my discount rate is 2%. So to me, I get that check year one, 4.5 million is worth 4.5 million. I go back next year, I get my second check. As of today, before I make that decision on what to do, that 4.5 million in a year is worth 4.4 million to me today. And under the higher discount rate, it was only worth 4 million and a little change. In 30 years time, that 4.5 million in 30 years, based on the smaller discount rate, is worth $2.5 million to me today. So in other words, I'd be indifferent of receiving 4.5 million in 30 years or 2.5 million today if my worldview of investment and everything was 2%. Safe, AAA, conservative, bonds. Whereas the higher risk person, the 4.5 million in 30 years is only worth 113,000 today. Okay, so for the risk adverse person, don't believe in the stock market. Um, if I took the annuity and I discounted by 2%, the value of that to me today is $103 million versus the lump sum of 80. I'd be, better off taking the annuity. And um, that's it's all a measure of the risk, right? And this is basically the way the stock market works every day. Some people, buy, like me, buy ATI Physical Therapy stock in January at 29 cents a share. Some people sell it to me. Even if we had the exact same, we have the exact same set of data and facts. We have their company's projections, but they're more risk adverse than me. I have more faith that they'll hit those projections. If you're interested, I think the stock closed at went to 48 cents. The month after I bought it, I was a genius. Now it's back down to 31 cents. I'm still 2 cents a share. So that's discounted cash flow Cliff Notes version. You don't have to, because of Excel, you don't have to do these calculations and these maths. You just have to understand the concept that there is a time value to money. So let's talk about the internal rate of return. So the internal rate of return, simple definition is it's the discount or interest rate where the net present value equals zero, i.e. where we're indifferent between a lump sum payment or the future cash flows. Okay, again, the difference between the present value and future cash flow discounted by an interest rate compared to a lump sum value today. So the internal rate of return, it's a surrogate for return on investment. So here, our discount rate was high. We want the money up front. Here, our discount rate was low. We want the annuity. There is a discount rate where we're indifferent between the annuity or the lump sum payment. And that's what the lottery is kind of based on. So that discount rate where you're indifferent between the two, where the net present value equals zero, is called the internal rate of return. It is a surrogate for return on investment. So let's determine what it is. So at 4.19%, the net present value of the future cash flows is $80,400,000. The lump sum that the lottery commission wants to give you is $80,400,000. Or yeah, that's right. At that, so if your position is, look, I'm not going to put in the stock market, but I'm going to do something a little bit better than T-bills. I want it kind of safe. I think I can earn, 4.1% all day long in the money. Then you're completely indifferent. And this is exactly what the way the lottery commission sets the lump sum. The annuity is based on their rules, right? The lump sum is basically what the lottery commission does. They don't hold on to let's say you take the annuity. They don't hold on to that money and dole it out to you every year. They don't hold on to the face value of that money. What they do is they go to the financial markets and they buy a coupon bond, and they say, given today's interest rates and everything else, I'm going to have to pay Dave Kanzler $4.568 million a year for the next 30 years. I'm not going to pay him. You're going to pay him. How much do I got to pay you today so that you'll pay him $4.5 million a year for the next 30 years? And they say, you got to pay us, we're going to invest it at 4.19%. You got to pay us $80 million. $400,000. And then that lottery says, okay, that's the lump sum payment. Dave, again, these are all after-tax numbers. We'll pay you the 80 million, or we'll pay the financial services company the 80 million, and then they'll send you a check for $4.5 million over the next 30 years. We don't care. We don't give, we're indifferent, because we're not going to actually send you the money. They are. So the 80, this top number, right, is the value, the present value of these future cash flows discounted by an interest rate. And we're comparing that to the lump sum. And the net present value is the present value of the future cash flows discounted minus the lump sum. And in this case, it equals 0. And when it equals 0, that interest rate or discount rate is, by definition, the internal rate of return. Okay, so let's do an application. So we have two projects, Project A and Project B. Go to slide 10. Our components: lump sum, annuity, and discount rate. Okay, so our lump sum for Project A is $400,000. That's the project cost. We enter that as a negative number. That's a cash outflow. Project B is $500,000. That's our project cost, right? We've done our modeling. We'll get into that a little later. And we project that Project A is going to bring us $75,000 a year for 10 years, cash flow. Project B is going to do $100,000. We've determined that our discount rate, our corporate cost of capital, is 7%. The most part, I'm going to give you these as assumptions. Which do you do? This one brings in more long-term money, but costs more initially. So you only have $500,000 to spend. You can do this and have an extra 100. I don't know. How do we determine? Well, Excel is your friend. So what we do is we set up a neat model like this, or laterally, nice and orderly. And to calculate the net present value, and again, if history shows, a lot of you are going to get this wrong, and all I can do is warn you and tell you to pay attention. The formula for net present value is equal NPV, comma, B16. So we start with the discount rate, comma, then we do the annuities, B18 to B27, B18 to B27, close our parentheses, and then we say plus the year zero outflow. Okay? We don't fight the problem. We don't, okay, again, we don't say minus B17 and enter the Y0 as a positive number. We don't do that. We enter the year zero as a negative number. It's an outflow. Why do we do this that way? And instead of minus B17, again, the user would be confused if you had a positive Y0 and positive Y1s through Y10. Okay? You can make it work formulaically. Why would you do that? Why would you confuse the user? Don't. Don't be putting Y0 outflows as positive numbers. Okay? And look at it. It's the first number is the discount rate, comma, then we do the outflows, we close the parentheses, and we do plus the year zero. That's the way it's done. When I did it, I had to use a calculator or do it in my head on the CPA exam with no calculator. Excel is your friend. It does it for you. Don't fight it. The internal rate of return, however, the setup is IRR, left parentheses. We start with the year zero and we go to the end and we close the parentheses. Okay? The IRR, the discount rate, is calculated for you because it's determining what the discount rate is. So we don't tell it. Now, the MIRR, and I think I asked you to do one MIRR, the modified internal rate of return. We start with the year zero, we go to the year 10, we comma, we give a suggested discount rate, comma, and a reinvestment rate, comma. So there's extra data items. Now, I'm not going to go into the esoterics. The MIRR is theoretically better for a whole bunch of theoretical reasons because it's taking into account how it's making more specific assumptions about how you would invest the $75,000 a year. It's not worth going down that rabbit hole. I've really never seen MIRR used in practice. Mostly we just use IRR. MIRR is theoretically better. Do you make a different conclusion based on it? Nah. There's enough modeling and variables in this process to, not get too excited about it. But you're going to have a problem on it just so that you can have a feel for it. So when you do the homework, people, don't fight it. Go to this page, print the page off, set your formulas, pay attention. Don't wait till the last minute, 5 minutes for the homework's due. It's simple stuff. Follow the structure of the formula. But I guarantee you some percentage of you are not going to do the formulas right. If past is prologue, I print the page out. You have an open book final. You have open book homework. Use the tools that are available to you. So I used Excel formula, and if you don't believe me, let's just show you. There's no magic here. It's not alchemy. Okay. Net present value. H6, my discount rate. H11 to H20, my outflows, close the parentheses, plus my lump sum 0. IRR, I just IRR painted year 0 to here. The MIRR, I painted H10 to the H20, and then I just did H6 twice. Keep it simple. Okay. Same with the other one, only I. Okay. Take it. You can pause the lecture notes if you want. Pause the video. Okay. So the net present value of project A is 126,769. Project B, 202,000. The internal rate of return, project A is 13.4%. Project B is 15.1. So I would take project B, right? Because it has a higher net present value than project A. It has a higher rate of internal, a higher internal rate of return than project A. Now, what this chapter doesn't factor in is project, are they equally risky? And that's what we'll dive into next week. Now, just to show you how the internal rate of return works. So if I replace that number with the discount rate, both these numbers, right? My net present value is 0 under both of these. Whoops. Okay, because I raised my discount rate. So that's what the IRR does. It tells me, and this just proves it, it tells me the discount rate where the net present value equals 0. Okay? I just proved it to you in case you didn't believe me. Okay. So, how do we determine if the project is viable? That's the ultimate question. That's ultimately what we're trying to decide in chapter 14 and 15. Is the project viable? So if we assume that our cost of capital or discount rate is 7%, right? Right? Again, the net present value is the difference between our lump sum, 400 in this case, 500 in that case, project B's case, and the present value of these future cash flows. Okay? And the internal rate of return is where the discount rate equals 0. Here's how we determine it. If the net present value is greater than 0 and or the IRR, the MIRR are greater than the discount rate, the project is viable. So you have to memorize that. Memorize it, memorize it, memorize it. It's going to be on the final. I'm going to ask you many times. If the net present value is greater than 0, project's viable. If the internal rate of return, or the MIRR, is greater than the discount rate, so the 13.4 is greater than the 7, the 15.1 is greater than the 7, the project's viable. Okay? So, let's review what we've learned so far. All in red. Cash flow is king or queen, be equal time. Cash outflow is a lump sum equals the investment equals the cost of the project. The inflow, we call it the annuity, the cash profit. Incremental cash flows are what matters. Non-cash items like depreciation are irrelevant. Sunk costs, past expenditures are irrelevant. Discounted cash flow. The discount rate takes into account the time value of money and the project risk, i.e. the risk of receiving those cash flows. Dig into more of that next time. Net present value is the difference between the present value of future cash flow discounted by an interest or discount rate compared to the lump sum value today, i.e. our lump sum, our outflow. The internal rate of return is the discount or interest rate where the net present value equals zero. And financial viability is net present value greater than zero and or IRR greater than discount rate. You need to memorize this. You need to commit this to memory. It's like this is the most important theoretical concepts. Okay. Wrapping this up for now. Cost of capital is based on an aggregate average risk. We'll learn more about that next week. Why do we care about net present value and ARR? Because capital projects involve large sums of money. Capital projects extends over a long period of time. Why does that matter? Well, we have inflation. We have the time value of money, which we just talked about. You know, stuff happens, obsolescence, risk, wars in Ukraine, COVID pandemics. The longer you project out, the more, you know, excuse my language, shit can happen. So let's do kind of a simple real world model on how we might set this up. So let me, page 20 and 21. Okay. So I guess we'll just do this on Excel. So typically when we build these models, so we have a project, a new clinic, it's 1.5 million. We're going to depreciate the cost of that over straight line depreciation over 5 years. That divided by 5, 300,000. And we decide our cost of capital discount rate is 9%. So the first thing we do is we build our typical financial model. Okay, and whatever, the kind of stuff we did like in chapter 5 or throughout the first part of the class. So whatever, we've got our revenue, we've got our less our variable costs, we got our contribution margin, we have our fixed costs, we have depreciation, we subtract, you know, again, I didn't do these as negatives, but you get it, profit, right? Contribution margin, less fixed costs, less depreciation. This is our profit. So the first step is we just do like a normal financial model projection like we would normally. You know that I like calculating profit margins, profit divided by revenue, right? Okay, so you'll be asked to do this in the homework and final, but nothing you haven't done before. Now, we've got to recast this in a way that we can do our net present value and IRR calculations. So a nice simple format is we take our profit and loss, from our financial model, A. It's not uncommon to start with a financial accounting measurement of net income. So we start with that for each year, right? So we just link it because we don't key in assumptions and variables. We build models, right? So we start with that. And then we add back depreciation, right? Because it's a non-cash item. It was subtracted to arrive at this net income, but we know depreciation is like one of the more famous non-cash items. So we add it back and we get our true cash flow in year one because we didn't actually shell out $300,000 a year for 5 years. Okay, so we take the 106, we add back the depreciation. So these are our actual cash flows. Cash coming in on an annual basis from doing the project. Okay, we have Y0, Y1, Y2, Y3, Y4, Y5. So Y0 is negative $1.5 million. Okay, it's negative, it's never positive. Don't be doing that to me. It's negative, the project cost, an outflow. And then I just have total here, just make it kind of neat and tidy. Then I have my year one actual cash flow, year two, year three, year four. So what I did here, there are situations where sometimes you have additional project costs later, maybe you say, okay, and this is hypothetical, it's 1.5 million, but I know that in year three, I'm going to have to spend, I'm going to have to replace a whole bunch of equipment that's going to wear out, and I'm going to have to spend $200,000. So when I build my model, you may have situations like that where, I know I'm going to have to replace. I can give you a perfect example. We had a capital lease with anesthesia machines, and we had 5 years, and then we had the option to buy them at the end of 5 years. And I just wrote a check for $90,000 to GE to buy out our anesthesia machine lease. So there are cases where your project costs outflows may not all occur in year zero, but that's fine. You just have a model that accounts for that outflow in a future year. I'm not going to be that tricky with you. On the homework, I'm just going to be pretty straightforward. But you see, my model does allow for that as a potential. Okay, so back on point. So we have our year zero, our 1, 2, 3, 4, and 5. So we'll do IRR first. So it's very simple. IRR, C60 to H60. So it takes into account the outflow, the inflows, pretty straightforward. It's 25%. Net present value. We start with B63. B63 is the 9%. That's our discount rate. D60 to H60 is our inflows, close the parentheses, plus the outflow. 758. Is the project viable? Yes. The IRR of 25% is greater than the discount rate, and the net present value is greater than 0. Okay? So that's approximate a real world example on how you actually do these things. We do a standard kind of pro forma. We take in the profit and loss. We make adjustments for any non-cash items. We frame it up in a neat, orderly format so we can use our Excel formulas. Bada bing. Okay, so the book talks about payback, and I just hate payback. Oh, God. Anybody that uses payback, you should make fun of. But the book covers it, and people do use it, so I have to teach it. So payback, the whole concept, it ignores the time value of money. It ignores risk. It just cares about how long does it take the cumulative cash flow to be greater than 0. It's a measure of time. It's not to be considered confused. It's a cash flow break even. It's actually a cumulative cash flow break even. I should adjust that slide. It's a cumulative cash flow break even concept. And it's sorry. It's fairly unsophisticated because it doesn't take into account the time value of money. And I remember when I first hospital job, the guy was probably my age at the time, talking about what's the payback and what's the payback, and me being like snoodle, kind of laugh at the guy, like who uses payback? But the textbook teaches it, so I'll teach it to you. The advantage. It's easier to understand conceptually than discounted cash flow. I mean, it's a pretty easy measure. How long does it take for me cumulatively to break even? Yeah, that's pretty easy concept to understand. The disadvantages, it's just not very, it doesn't take into account the time value of money, right? And the other major disadvantage is it ignores anything that happens, after you have the cumulative cash flow break even point. Just kind of, it just kind of ignores that. So it's not very good, but there you have it. So this is a little, let me load up Excel. It's just a little more awkward. So here's the simplest way to do it. We set up our cash flows just like we would normally. We have our years 0 and our year 1 through 4 in this case. And then what we have to do is we have to measure the cumulative cash flow. So how do we measure the cumulative cash flow? Just think of it like if you did this with a bank account. We start with year 0. Our cumulative is what we just shelled out. Our cumulative after year one is our year zero cumulative plus our year one inflow. Okay? Our year two is our cumulative year one plus our year two cash flow. Our cumulative year three is our cumulative year two plus our year three cash flow. And our year four is our cumulative year three plus our year four cash flow. So the thing that you got to pick up here, see if it's a little easier without the color. Okay, it's a little easier without the color. So D14 is the year one cumulative, that's like a balance, plus year two's annuity payment. And it's much easier without the colors. Year three is the year two cumulative plus the year three cash flow. And I'll just do the other one. Okay, so year two cumulative, year one cumulative was the year zero cumulative plus the year one. So it's like a, revolving your credit card balance without interest. If you're $15,000 in a hole, and every year you make a payment of 4, 4, 4, and 10, assuming no interest, this would, what your balance would be. So this is how we calculate payback. You just have to take it step by step. We take the last negative year of cumulative cash flow. So in the case of Project Yuga, the last negative year was 2 of cumulative. So year 2 was negative, year 3 was positive. So I just linked to year 2. For Project Jenny, Yuga is the name of my boat, Jenny is the name of my dinghy. The last negative year of cumulative was year 3. So I linked to year 3. Then we have to take the remainder divided by next year's cash flow, and we have to add it to the last year. So this is where it gets a little tricky. How much is left? How much left in the last negative year? How much was left to go for it to become net zero? Well, it's just obviously the balance, the negative balance of that last year. So in other words, we were negative 7,000. The last year we were negative cumulative, was year 2. So we had $7,000 left to get to that cumulative break even. So it's very simple. It's just minus the last year. It's $7,000 left. In this example, we had $3,000 left to get to that 0 point. So it's just negative 7. We'll do this without colors. Okay, whoops, negative 3. Sorry. So minus the last year of cumulative of negative cumulative minus the last year of negative cumulative. Okay, and then we take the next year's actual cash flow. So the last year of negative was year 2, we pick up the last year of actual, which is year 3, 8,000. In this case, the last year was year 3. We pick up years 4's cash flow, and then we divide the 7 by the 8, the remainder divided by the next year to get 0.9. In this case, we divide 3 by the 10, and we get a fraction, and we add that together. So basically, it makes sense logically if you think about it. We were $7,000 in the hole. We're going to earn $8,000 next year. So it's going to take us 7/8 of the year, or 0.9, to earn to the point where we're completely at zero. In this case, we were -3, at 3,000 left to go. The next year we were going to earn 10. So 3/10 of the way through the year, we would get to the 0 point. So we add the 0.3. So again, people have more trouble with payback than with anything. Just print the page of the lecture notes out. And just, do it. Follow the examples. Don't confuse. I'll tell you, people confuse the cumulative, and it's bulky. You just got to follow it. So in this example, we added to our model the cumulative cash flow. So we had the -1.5, which is our year 0. We added the 406. We got to -1 million and change. We added the 493. We got to -600,000. We added the 588 from year 3. We got to -11. So we're almost there. Year 4, we've got the 681. Year 5, the 1.488. So the last year of negative cash flow, so the last year that cumulative cash flow was less than 0 was year 3. So in this case, we enter 3. The remainder left to go, well, was 11,396. So minus the negative is a positive. The next year's cash flow was 681. So we take the 11,396 divided by this. I'm sorry, I'm a dope. The next year was, see how hard it is, confusing? The next year was 693. So see, that's why I hate payback. So let's redo that. The last year of negative was -11,396 of cumulative. So we have the 11. Next year's cash flow was 693. The 681 is the cumulative. So the next year's cash flow is 693. I bring that down. I divide the 11.396 K divided by the 693,144. I get 0.02. I add it to the 3. It pays back in 3.02 years. So that's payback. Gave you an example. Again, you just got to be meticulous and careful. You see how easy it is to get confused. Miscellaneous project scoring, we'll talk about that. It's very institution specific. We're touched about in 15. Post-project audit review, absolutely. You should do comparisons of your project's actual results against your pro forma. It's just kind of like your budget variance. I'll just tell you, there may be examples of encouraged but frowned upon. It depends on the culture of the organization. I can tell you that one of the reasons I left the University of Chicago many years ago was exactly over this issue. There was a project. One guy was gung ho for it. I ran all the analysis, says it was no, it wasn't going to work. Or, I did all this classic, all the stuff you see here. Ticked and tied, beautiful work, all organized. I said, this isn't good. It's negative. It's not viable. My boss was for it. Actually hired Anderson Consulting to basically do my job because they didn't like, and I wouldn't give on it. I'm like, this is it. Hired Anderson Consulting to do an analysis, and they just pumped up the numbers. They just inflated the projections. They inflated these projections, till they got to an NPV greater than 0 and an IRR greater than the discount rate. And, and University of Chicago, at my boss's insistence, spent, I don't know, 10, 20 grand to have them redo my work and just inflate these numbers. So we went ahead and did the project. And then, a year later, here's me. We need to do project audit and review. And I definitively rubbed it in everyone's face that my numbers were right. My boss wasn't happy about it. And that was the beginning of the end of my tenure at the University of Chicago. A year after I left, the division I worked for basically went bankrupt. My boss got fired. Some other people got fired. But I was still just the guy who did things that were encouraged but frowned upon. I was already gone. So there's, it doesn't always work out the way you hope for. Okay, this is it for chapter 14. Let's pull up the homework quick. By the way, you know the drill. I only want mathematical functions. Don't be keying anything that you're not supposed to. If you get lost, Excel will, if you go to, I'll pull it up in a second. It'll walk you through these formulas. These are not tricky. These are not difficult formulas, but you can actually have Excel just walk you through it. So let's pull up the homework. Homework. Okay, so very simple. I guess I just changed the format here. You can, orange is, you can key in the assumptions and the answers. I don't need to change those to blue, do you? Do I? You're good? So you're just going to do formulas here, orange. You're going to key in assumptions. It's 14.2, 14.5, and 14.6 from the book. Formulas in green cells only, and that includes H23, I23, and M. So H23, last negative year. Yeah, just plug, I set this up. Don't be keying in 3 or 2. Don't be doing that. Just link if it's a 2. Link if it's a 3. Okay? Remainder divided by next year's cash flow. Look at me, I laid it out for you pretty well here. And then let's say you're doing the IRR and you get really confused. You can go formula, do financial IRR, and it'll take you. It'll walk you through it. NPV, financial net present value. You'll pick the cell with the rate. You'll do again, I wouldn't do this. I would just look at the book and look at the notes and do the formula. But if you're completely lost, you can have it walk through you. I think it's just simpler to look at the lecture notes and type the formula in. Okay, so pretty light homework. This shouldn't take you more than, I don't know, it can't be more than 20 minutes. Okay, that is it.